Hello everyone, welcome to week 2 lecture video once again. In this video, we will be discussing the relationship between risk and present value. In the last video, you can remember we have seen an example of an office building. We have seen that an office building is constructed at $700,000 and we expect to sell this office building at the end of year one with $800,000 and the cost of fund was 7%. So we discounted this 800,000 with 7% and we got a present value of 747,664. Since our initial investment was 7,000 and present value of the cash inflows are greater than initial investment, we decided that we will accept this project as a net present value. I mean, the difference between present value of inflows and outflows was positive. Now we need to understand one point, that these cash flows, 800,000 that we expect to receive in year one, is not a sure thing. It's not certain. Now, if investor can earn the 7% return from government securities, in that case, investor will surely invest in government securities rather than investing in this office building project because they can earn the same cash flow without taking any risk. Now, if investor to invest in this office building project and it is more risky, then investor must want a return higher than the 7%. So you understand that all investments are not equally risky. Different investments have different risk. Now, as an investor, if you take a more risky project, if you invest in a more risky project, you will want a higher return. And if you invest in a less risky project, you will be happy with a lower rate of return. That's why it's very rational that different projects will be discounted by different discount rates based on the riskiness of the project. So here we invoke the second basic principle in finance, that one safe dollar is worth more than one risky dollar. Okay, so since a safe dollar is worth more, investors try to avoid risk without sacrificing return. Now come back to this example. If we assume that the riskiness of this project is higher than the government security and interest rate on the government security is 7%, so since this project is more risky, we should discount the cash flow of this project at a higher discount rate. And let's say that's equivalent to 12%. Okay, that means as an investor, if you invest in this project, you would expect a return of 12%, which is 5% higher than the return you expect from a government security. Now, instead of 7%, we discount these cash flows which we expect to receive in year one. We discount this cash flow by 12%, and we can now say that the present value of this cash flow is 714,286. Well, this cash flow, I mean the present value of the cash flow, is still higher than 700,000 and NPV is still positive. So you can see that if we consider a 12% rate of return instead of 7%, still this project is acceptable because NPV is positive. So the bottom line of this discussion is we would discount the cash flow of a project based on the riskiness of this project. A highly risky project will be discounted at a high discount rate, and a low risky project's cash flow will be discounted at a lower discount rate. We will be discussing more detail about the association of risk and net present value in some future weeks. So as we already discussed, the net present value rule is accept an investment that have a positive net present value. Now intuitively you understand that when we have a positive net present value, as you have seen in the last slide, when we have a positive net present value, it means that the present value of the inflows that we receive is higher than what we invest. So this excess cash flow is supposed to add value to a company. That's why as long as NPV of a project is positive, we accept the project. So this is a very similar example where 800,000 is discounted by 10% and initial investment is deducted. So NPV is 27,000. So we will accept this project. Now come to the rule of rates of return. Now we have decided that we will accept that office building project based on positive NPV. So it was a smart thing to do because it's worth more than its cost. Now to discover how much it is worth, we ask how much we would need to invest directly in securities to achieve the same payoff. This is why we discounted the project's future payoff by the rate of return offered by these equivalent risk securities, the overall stock market in our example. Okay, now we can state our decision rule in another way. Okay, that is the rate of return rule. Now, your real estate venture is worth undertaking because its rate of return exceeds the opportunity cost of capital. So how do we calculate the rate of return? Rate of return is simply the profit as a proportion of your initial outlay. Okay. For example, the office building project, you expect to receive 800,000 at the end of year one, and you invest 700,000. So this difference is the profit, and you divide it by 700,000. So profit as a proportion of investment, this 14.3%. So this is your rate of return. Now, as the NPV rule was, we will accept a project if NPV is positive and we will reject if NPV is negative. Now, what is the accept reject decision based on this rate of return rule? So based on this rate of return rule, if this rate of return is higher than our cost of fund, cost of the capital, then we will accept project. And if this rate of return is lower than the cost of capital, then we will reject the project. Okay. For example, here our rate of return is 14.3%. Now, if our cost of fund is 10% or 12%, then we will accept this project. It is intuitive. If your cost of capital, let's say 10%, it means that the money that you are investing, the cost of raising this money is 10%, but you are earning a return of 14.3%. That means you are earning an excess return of 4.3% that's supposed to add value to your business. So your project is acceptable. So by this time, you can see that we have two equivalent decision rules for capital investment. One is net present value rule, another is the rate of return rule. Net present value rule is accept investment that you have a positive NPV, and rate of return rule is accept an investment that offers a rate of return in excess of their opportunity cost of capital. Now let's extend our discussion on our NPV. So far, we have seen an example where we expect a cash flow at the end of year one. We discounted it to get the present value, and we compared with initial investment to decide whether we accept or reject a project. Now, a project does not necessarily have only one cash flow. A project may have a series of cash flow arising in multiple periods. Look at this example here. You may have a project where you have a series of cash flows, for example, C1, C2, up to CT. Now, to calculate NPV, what we need to do is we need to find out the present value of each of these cash flow. We sum them up. So you can see the part of this NPV formula. This is the sum of the present value of inflows. Then we deduct initial investment. And the decision rule is still the same. If NPV is positive, we accept the project. Otherwise, we reject. So look at this example. We have a project where initial investment is 700,000. Year one and year two cash flows are 30,000 and 870,000 respectively. To calculate NPV, first of all, we find out the present value of 30,000. So this 30,000 is discounted by the cost of capital, which is 12%, and 870,000 once again is discounted by the cost of capital, which is 12%. And you can see in year one, we divided by 1.12, and year two, we divided by 1.12 square. The reason is the cash flow is occurring in year two. So these two, 26,000 and 690,000, these are the present value of the cash inflows. We sum them up and we deduct initial investment, which is 20,344, which is the net present value. And this is obviously positive. And since it is positive, we will accept the project. So this is the end of our discussion in this video. Please watch the next video to understand the concepts of annuity and perpetuity. Thank you.